Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at a few blue chip tech stocks to consider buying at rather substantial discounts and holding amid all of the current market uncertainty. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into the few blue chip tech stocks we're going to consider buying today, I want to do a broader market overview just to give context for whatever the two stocks we're talking about are. So stocks made a bit of a comeback this week after what was a brutal week last week that saw the S&P 500 officially fall into a bear market and post its worst week-long stretch since the initial COVID crash of 2020. So as I'm recording this early afternoon on Friday, the S&P 500 and the NASDAQ were both up about 2.4%, with the Dow up about 2.2%. So nice big bounce on Friday as well. And this came after Wall Street spent the last 2 days listening to Fed Chairman Jay Powell speak to lawmakers in Washington. So Powell has continued to stress that the Fed will do all it can to drag down inflation from 40-year highs after they lifted rates by 75 basis points last week. The Fed's goal is to try to engineer what's a so-called soft landing for the economy, which is essentially raising rates, clamping down on inflation without sending the U.S. into a recession. This is obviously no easy task, and many on Wall Street are now shouting from the rooftops that the U.S. is on the cusp of a recession, or some are already saying we're in one. So a technical recession constitutes, from the National Bureau of Economic Research, who's technically saying what a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Meanwhile, the shorthand is still considered 2 consecutive quarters of negative GDP growth, which some projections say we are headed for following a 1.4% pullback in Q1. Others argue that it's really hard to be in a, quote, recession when May's unemployment held near pre-COVID lows at 3.6%. Labor force participation ticked up. The U.S. economy added nearly 400,000 jobs to crush Wall Street estimates. There's still 11.4 million job openings, which is sky high. That said, the economy is cooling. We're seeing tech companies already cutting jobs and rescinding offers, as well as some other areas that have seen quick downturns. So housing and mortgage-related firms are cutting back, which is actually a positive sign if we're trying to talk about inflation and cooling the economy. So maybe that the Fed doesn't have to really ramp things up. We also should note that consumer sentiment is at historic lows, and people are staring at sky-high gas prices and soaring grocery bills, which are made worse by continued stop and start COVID lockdowns in China and the Russian invasion of Ukraine. The slowdown in consumer spending, though, will go a long way in cooling off prices in the heavily consumer-focused U.S. economy, which accounts for about 70% of the entire economy. So the Fed and other central banks are on that inflation-fighting path, and they're going to continue to do that until they see signs that prices are coming down, and they're going to continue to come down. So the next few months of the summer will be crucial. So June CPI print, which is due out July 13th, could be big. And then the second quarter and third quarter earnings season will be really pivotal as companies provide updated guidance amid higher interest rates and rising inflation, and seeing how cooling spending is doing. And obviously valuations are continuing to be compressed in the face of these higher interest rates. And we should also note that I saw a Wall Street Journal article on Thursday that was pointing about that retail investors or individual investors are feeling really downtrodden about investing. They're near 2008 lows. This downbeat view comes despite the fact that individual investors are still buying stocks in 2022, which shows that they're probably being very pragmatic, long-term buyers who are saying, hey, we might feel bad about buying these stocks in the near term, but long term, they're going to be winning plays if you're holding these stocks for 10 years or longer, which most people are if they're planning for retirement. So obviously, it's worth noting that historically, investors are the most bullish before downturns and most bearish really before rebounds. So it's good to see this sentiment being at these 2008 lows because that's just a good sign. When everyone gets really negative, maybe being contrarian and starting to buy some stocks is good. And we've seen some bounces recently. So maybe if you're a longer term investor and you aren't worried about the near term downside of, say, the next 3-6 months or even a year, buying some of these big blue chip stocks at the current levels and holding them for a really long time might not be a bad idea at all. So we're going to dive into 2 of these blue chip technology stocks to consider buying with that background. The first of the 2 stocks we're going to dive in today is Microsoft, trades under the ticker MSFT. Microsoft, obviously a big name. It doesn't need much of an introduction, but the technology titan did really recalibrate its entire long-term trajectory of its business with its expansion into the cloud computing industry. The stock obviously has tumbled, from its November peaks alongside pretty much most other tech firms in the market. This is due to rising interest rate environment and economic slowdown fears more recently. We should note that the company in early June trimmed its sales and earnings guidance on the back of currency headwinds. This is the effect of a strong U.S. dollar as more people are piling into safe havens in the U.S. So Microsoft said that the strong dollar would reduce its sales outlook by about $450 million, give or take, which is not that big of a deal when you consider that the company's set to make $50+ billion this quarter. The cloud computing firm also lowered its EPS guidance to between $2.24 per share and $2.32 per share. This is from a high of $2.35 per share. So they cut it by a couple cents per share on the bottom line. Wall Street's also worried that Microsoft, along with many other companies, might guide even lower when they report. So its Q3 2022 results are due out in late July. But even if the firms suffer more downbeat guidance, its long-term outlook and its fundamentals help make it a really attractive place. So we're going to dive into all of that right now. So Microsoft has been able to thrive alongside Amazon and many of these other cloud computing companies in posting really impressive growth rates, especially for a company of its size and age. So alongside its cloud computing business, it's still operating a really successful Microsoft Office and Windows unit. This is still really valuable from large enterprise companies to students and everyone in between. It's also prepared to continue to thrive in this hybrid working world and really just digital work environment. It has offerings that compete against Zoom and Salesforce. It also has its Surface business, Xbox, so that gaming unit, LinkedIn as well. So, and we'll get to some more gaming possibilities in a second. Microsoft's fiscal 2021 revenue, so last year's revenue climbed 18%, which came on top of 3 straight years of about 14% sales growth. And its current estimates, so our current Zacks estimates are calling for another 18% growth in 2022. So this is despite, and obviously these could trend in the wrong direction depending on what they actually report next quarter, but still, the most recent estimates are calling for another 18% growth and then another roughly 13.5% growth on the top line next year to get all the way up to $225 billion in revenue. These estimates highlight that growth and consistency of that cloud computing market, and it would then be set to do 6 straight years of double-digit top-line growth. The cloud computing business is also a pretty high-margin endeavor, so the company posted 40% adjusted earnings growth last year, and we're currently calling for another roughly 17% adjusted earnings this year, and then 14% higher in 2023. And so when we're talking about some earnings revisions lower amid the company guiding lower with the currency headwinds, so the what they reported in early June. So we've seen their full year estimate fall a couple cents from a $9.32 per share to $9.28 per share, with 2023 coming down from $10.62 per share to $10.59 per share. So we're not seeing anything drastic in terms of these revisions, just a couple cents lower for these massive companies. And the company has also easily beat our earnings estimates over the long term, and in the last 4 quarters, they've beat by an average of about 9%. The company is also really a money printing machine. It closed last quarter with about $105 billion in cash and equivalents. It returned about $13 billion to shareholders via buybacks and dividends, which was up 25% from the year ago quarter. So they're doing a bunch of buybacks as they see their stock price falling because they see it as a value, like great value at the price it is now. It also raised its dividend back in September by 11%. And as I mentioned, approved a new share repurchase program. The company also has a really impressive balance sheet along with those piles of cash, which could help it continue to make big and small acquisitions, which it's done for years and years in a row. The big headline acquisition that's still up in the air, it might not go through, is its plan to buy Activision Blizzard for about $69 billion in cash on what appears to be a deal on the metaverse/VR gaming. But as I said, the deal's still up in the air. It has not closed. Wall Street seems to be kind of betting that it might not happen at the moment. But if the deal did go through, it would be Microsoft's largest acquisition by far. So the $69 billion deal would come in way above the next closest deal, which was LinkedIn back in 2016, which it bought for $28 billion. So this is a big deal. And obviously Microsoft sees it as something that's that important. So we'll see if it gets through. But even if it doesn't go through, it doesn't really matter in the grand scheme of Microsoft's business. Obviously, it would help diversify and expand, but all the estimates we just talked about have nothing to do with this deal closing in any way. And we should also note that Wall Street's still really high on the stock. 21 of the 23 brokerage recommendations Zacks has are strong buys, with the other at a buy and just one hold. So looking at the stock price, the stock's up about 275% in the last 5 years. This crushes the Zacks tech sector's 67% run. That said, the stock's now down around 23% from its peaks. It's trading around $264 per share the last time I looked on early Friday afternoon. And it's now trading roughly where it was a year ago. This also gives it about 30% upside to its current Zacks consensus price target. And then on the valuation front, things are looking pretty strong as well. Obviously, things have been recalibrated amid these higher interest rates, which then, just recalibrates your forward earnings outlook. So right now, Microsoft's trading at about 24.5 times forward 12-month earnings, which is right at its new 2-year lows. And it's not too far off its COVID lows. And in terms of where it's been over the last 5 years, it's trading below its median over the last 5 years and well below its highs of about 36 times forward earnings over the last 5 years. And if we look back to pre-dot-com bubble levels, we're trading way, way, way below those levels. In the late 90s, Microsoft traded as high as about 66 times forward earnings. And then at the lows of the post-financial crisis downturn, it was trading near the 10s. So we're up from there, but recalibrated in a big way from where the company was at the last big bubble. So we're now at about we're below 5-year medians and way near those COVID lows. So valuation-wise, Microsoft's looking pretty solid, and its outlook continues to look great. It's currently a Zacks ranked number 3 hold, and long-term investors might want to consider Microsoft for all the reasons we mentioned. Obviously, the near-term economic and market activity is still pretty up in the air, and you could see way more downside. So maybe people want to wait until after the company reports in late July to see its real guidance for the rest of the year with more information and more consumer spending and more inflation baked into the cake by then. But if you're a longer term investor, you don't need to worry just so much about timing the market precisely. So the next stock we're going to look at is another big name that might not occupy the same part of the technology stratosphere as, say, Microsoft or Apple, but it's pretty up there, right below those big names, and that is Adobe, which trades in the ticker ADBE. So it's a creative and design powerhouse that went public back in the mid-1980s. And it really has a compelling case for really the best of the rest of those blue chip tech stocks. Adobe is starting to reach levels that should make it attractive to long-term investors. And it's already reported its earnings. So it reported on June 16th, so last week. So analysts have been able to provide some updated guidance in the face of everything. And the company has also been able to provide updated guidance, which is great for investors to know that the company is providing guidance, knowing what's going on right at the economy, where some of these companies were providing guidance, say, 3 or 4 months ago. So now let's break down the company, what they do first before we dive into the recent report and some of the other fundamentals. So Adobe's portfolio of subscription-based software includes Photoshop, Premiere, InDesign, Illustrator, and many others. It has nearly 30 unique software offerings, and the company's products help users edit videos, images, create artwork, artwork, books, do pretty much almost anything that a creative and design world might imagine on a computer or tablet or smartphone. So its Adobe Premiere software has been really the industry standard in video and film editing for decades. It's used to edit Hollywood movies and a student film alike. So that's how ubiquitous the software is. The company has introduced slimmed down versions of some of these offerings geared towards shorter content and faster turnaround times for the social media age. And we should also note that the company really turned its entire business around and has been on a tear since it introduced its subscription model for all of its offerings about a decade ago. It also has a package bundle, which is called the Creative Cloud, that currently runs essentially $55 a month for individuals. There's definitely different packages for businesses and schools and more, but these are products that once you start paying these $55 a month for individuals, you're likely to continue to pay going forward, because this is something that's essential to what you do. And this is, we'll show in a second just how much growth this has managed to help the company. And along with its creative portfolio, the company does have a broad range of business-focused offerings. This includes a document business, PDFs, e-signatures, marketing, commerce, workflow, digitalization, all of this. So it's a really expansive cloud software company. So its 2021 sales climbed 23% to $16 billion. This extended its streak of 15% higher revenue growth to 7 straight years. So that's essentially when the company started doing its monthly subscription services. You could also do yearly subscriptions, but that's when the company really changed everything. That was back in 2012 when they first rolled that out. The company's then topped our Q2 earnings and revenue estimates last Thursday, with its adjusted earnings up 11% and its revenue up 14%. So despite that beat and that growth, the stock dropped after the release on the back of slightly lower than projected guidance for 2022 and the current third quarter for Adobe. So its updated guidance calls for about $17.65 billion in revenue, which came in just below the Zacks estimate last week of about 17.79, and its adjusted earnings came in about $13.50 versus what was our consensus at the time, about $13.59. So just 9 cents lower for the year. So that's just giving you context that they're not providing insanely lower guidance. The company is still projecting pretty impressive growth, which we're going to get to, but they did point out, which is why they guided lower, the impact of the ongoing war in Ukraine and its decision to cease all new sales in Russia and Belarus. As part of the reason for that subdued guidance, the company, like Microsoft, also mentioned the strong US dollar impacting its business, along with some other near-term headwinds. Since then, Wall Street firms have lowered their Adobe price targets. That said, with this new guidance baked into the cake, Adobe's revenue is still projected to jump 12% in 2022 and then another 14% in 2023 to hit over $20 billion for the first time. And its adjusted earnings are still projected to surge 24% last year. They're projected to now climb 9% this year and then over 16% in 2023. And then, as I mentioned, the subdued guidance is really not much lower than what it was before. It's a few cents lower for the year. And if we look to 2023, before the company reported, we were calling for adjusted earnings of $15.85 per share. We're now calling for adjusted earnings of $15.77 per share. So less than 10 cents lower on the bottom line for 2023 with its most recent guidance baked in. And the company is also consistently beat on the bottom line. So now in terms of some other fundamentals and some stock price movement, the stock is down a whopping 45% from its November peaks. When it was trading at around $700 per share, it's now trading at around $382 per share. With that price, it could easily be a stock split candidate as well. Obviously, this is speculation, but a lot of these companies in the tech world that have traded at a really high per share price, Tesla, Shopify, Apple's done it recently, Amazon's done it recently, might be a candidate to just lower its price artificially, make it more attractive to the average investor. So Adobe's now trading where it was in May of 2020, which is also essentially where it was at its pre-COVID peaks. So despite this fall from its highs, the stock's still up over 1,000% in the past decade. This blows away the tech industry's climb. And the fall has also really recalibrated Adobe's earnings outlook. So it's currently trading at its lowest levels by far in the last 5 years. So it's trading way below its COVID lows. It's now trading at about 30.8 times forward 12-month earnings. And well below its highs, it was trading at about 64 times forward earnings just about a year ago. And it's now trading well below its median over the last 5 years as well of about 41. So it's trading at 30.8 times forward earnings at the moment. And it's now essentially trading at its lowest levels since right before it rolled out its subscription model. And that's really when the stock started taking off. And it's not even trading. It's trading essentially where it was for most of the early 2000s as well. So its valuation has been really recalibrated in a nice way. And then if you just want to take a broader look, just think of and this goes back to the question of investors feeling really bullish, maybe at the peaks, and really bearish, what could be in retrospect the bottom. So think of all the people that were really excited to maybe buy Adobe stock when it was trading well above $600 a share, nearly at $700 back in November. But now those same investors don't want to touch Adobe when it's at $380 a share. So that gives you a sense that if you're a longer term investor, maybe you want to consider buying it at these levels. It's currently a Zacks Maker for 3 hold, and 18 of the 22 brokerage recommendations that we have are strong buys, with nothing below a hold. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.